Picture this, it's 1978, no TradingView, no Binance, no algorithmic bots running the market, just paper charts, pencils, and calculators. And at his desk sits J. Wells Wilder, not a Wall Street legend, a mechanical engineer, with one question. How do you measure the strength of a market move before it's too late? His answer became one of the most widely used trading tools in history. A single formula that plots a line between 0 and 100. That tool is a relative strength index, also known as RSI. And here's what's crazy. Wilder created it before personal computers. Yet today, nearly 50 years later, RSI still sums up every chart in stocks, forex, and crypto. But here's the twist most people miss. RSI was never designed as a simple buy low, sell high button. In fact, Wilder himself said letting your emotions override your plan is the single biggest cause of failure. So let's break down what RSI really measures, how it's used in crypto today, and why prop traders treat it very differently than retail. Through the 80s and 90s, RSI exploded in popularity among stock and forex traders. It was simple, visual, and adaptable. Fast forward to today, and crypto traders use it everywhere. Bitcoin on the daily, altcoins on the 1 minute. But crypto isn't like traditional markets. It never closes. Volatility is brutal. And RSI signals can whipsaw you if you take them at face value. That's why the smartest traders don't just look at the number. They watch for divergences. For example, Bitcoin makes a higher high, but RSI makes a lower high. That's not confirmation, it's a warning. And if you've been in crypto long enough, you've seen it. Remember Ethereum's parabolic run in 2021? RSI didn't reverse at 70, it stayed pinned above it for weeks. Anyone who sold just because it was overbought missed the move of a lifetime. RSI is what's called a momentum oscillator. Instead of just tracking price, it measures the speed of price changes. By default, it looks back 14 periods. Each candle closes, RSI updates, and you get a number between 0 and 100. Most beginners hear the rule above 70 overbought, below 30 oversold. But here's the catch. Wilder never meant buy at 30, sell at 70. RSI was built to reveal when momentum is strong or when it's starting to fade. Think of it like a heart monitor. A spike doesn't always mean danger. It means intensity. And without context, you'll misread the signal. Now, I know what you might be wondering. Should you change the RSI setting? Well, some crypto day traders shorten it to 7 or 9 for faster signals. That makes RSI react quicker, but it also makes it noisy. Longer settings like 21 smooth things out, but you get fewer signals. Timothy Sykes, a well-known day trading educator, says he sticks with the classic 14 on intraday charts, especially the 15-minute, because it balances speed with reliability. So the truth is, there isn't a single best setting. It depends on what your style is. And honestly, I'd love to know what you use. So drop it in the comments because that debate has been going on for decades. Here's another big misunderstanding. People think RSI above 70 means a rally has to reverse. But in strong uptrends, RSI can be pinned at 70 or even 80 for days. That doesn't mean an indicator failed. It might just mean that the market is in a strong trend. Investopedia even points this out. In uptrends, RSI often lives between 40 and 80. In downtrends, between 20 and 60. And this is where smart traders add a second layer. They combine RSI with a moving average. The moving average gives you the trend. RSI tells you whether that momentum inside that trend is fading. Put them together and you avoid one of the biggest mistakes beginners make, trying to short strength or buy weakness just because RSI looks extreme. And if you want to see how RSI stacks up against other tools, our team at Mubite actually ranked the 7 best indicators for crypto prop trading. RSI made the list, but what's more interesting is how traders use it. The article is in the link below if you want to deep dive. Now, we already know RSI works best when it's not alone. Pair it with moving average or MACD and you filter out noise. But one of the most powerful pairings is with volume, because RSI shows you the pulse of a move, but volume shows you the commitment behind it. If RSI shows divergence while volume is drying up, that's a red flag. Momentum is weakening and nobody is stepping in to support the trend. But if RSI diverges while volume stays heavy, that's conviction. The market is shifting and the crowd is behind it. Zane Bauda, an analyst at Oanda, emphasizes this too. RSI shines when you zoom out, add context, and align it with other factors. It's not the driver, it's the pulse. And here's where retail and prop traders split paths. A retail trader often sees RSI as a trigger. It hit 30, time to buy. It hit 70, time to sell. A prop trader sees RSI as a filter. They'll only take longs if RSI confirms momentum is shifting. Or they'll use divergence as an early cue to tighten stops, protecting capital before account violation. And that's the real edge. Consistency discipline, and risk management. Because in prop trading, it's not about hitting one home run trade. It's about staying in the game. So is RSI reliable? On its own, not really. But paired with the trend, divergence, and context, absolutely. One massive backtest looked at over 23,000 RSI trades across 8 centuries of market data. The verdict? RSI 14 on an hourly chart had a 53% win rate, with wins averaging bigger than losses. Not perfect, but enough to keep you in the game. And that's really all trading is. RSI has outlasted almost every fad in trading. Why? Because it doesn't just measure price. It reflects human behavior, fear, greed, even exhaustion. In fact, the same idea behind the crypto fear and greed index. Different tool, same principle. The market is ultimately a mirror of human emotion. When you pull up RSI, you're not just seeing a squiggly line. You're seeing the pulse of the market. So the next time RSI dips below 30 or spikes above 70, don't just think buy or sell. Think about Wilder in 1978, creating a tool that's still helping traders navigate crypto in 2025. If you want the full article on the 7 best indicators for prop trading, the link is below. And if you want to catch the next installment of History of Indicators, like MACD or Fibonacci, make sure you subscribe, leave a comment, and visit us at Mubite.com. Because indicators aren't just lines on a chart. They're history, they're innovation, and they're edge.